Good afternoon, this is Sean Golden with Golding & Golding, here to discuss the basics of the India and U.S. tax treaty. India and the U.S. have entered into a tax treaty, really hasn't been updated much in several years. There's a technical explanation, but that goes on forever. I'm here to just kind of give you the basics. Baseline perspective of the way I do these types of presentations, this one for example, is that you're a U.S. citizen and you're living in India. The idea is the U.S. uses something called a worldwide income model. It's ridiculous, but it basically says if you're a U.S. citizen, the U.S. gets to tax you on your worldwide income. You could be living in India, earning all your income in Portugal and Australia. U.S. doesn't care. You're a U.S. citizen. They want you to include everything on your U.S. tax return. Now, there's ways to work around it. You may qualify for something called the foreign earned income exclusion. You may qualify for foreign tax credits to minimize the tax. But at the end of the day, baseline perspective I like to use is that the U.S. taxes its U.S. citizens on worldwide income. Now, there's also U.S. persons, which means U.S. citizens, legal permanent residents, and foreign nationals who meet the substantial presence test. But when we're dealing with the treaty and the limitations, that's basically going to impact the U.S. citizens because of the saving clause, which we'll get to in a minute. All right, so let's go through some of the common issues. Real estate, okay? If a U.S. citizen was in India, has Indian real estate, and they sell it, can the U.S. tax them as well? The answer is yes. Some treaties will limit the taxation of income derived from the sale of property to that country. So if it was India, then the property is located in India, and only India gets the right to tax it. The U.S. doesn't do it that way. The U.S.-India tax treaty says, hey, we both get to dive into your pockets and pull out the money. You can claim foreign tax credits, so if you paid it in one country, you claim the credit in the other country. India operates on a different tax year than the U.S., so depending on when you paid it, which return you're filling out, what year you sold it, yada, 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 you claim the credit. Dividends and interest. Okay, so with dividends and interest, both countries get their take, but there are some limitations. So depending on which country it's sourced in, where it's earned from, they can tax you on the income. But then depending on where the country of citizenship is or residence, they get a chance to tax you as well, but it's limited. So basically what happens is there's a limitation as to the second contracting state that gets the opportunity to tax you. General rules are for non-residents in the U.S. If it's taxable, because interest is usually sourced, is not normally taxable. It's not normally sourced in the U.S. for non-resident aliens. Dividends are generally taxable. In accordance with the treaty, which isn't just for non-resident aliens, right? But according to the treaty, it reduces that rate for people who qualify. It depends, 0.5, 10, 15, 25%, depending on the source and the type, okay? Pensions. Pensions are super complicated. Different treaties have it's always the most complicated section because you've got pension, you've got private pension, you've got public pension, you've got Social Security, and then how is it taxed, where is it taxed? The other problem is the saving clause. So basically, you're a U.S. citizen and you're overseas, and you're reading the treaty, and the treaty makes it sound like it says, hey, only the country where you derived the income that's now paying out the pension is where it can tax you. So if you worked in India and your pension's coming from India, then India can tax you, right? But the problem is the saving clause makes it so that for U.S. citizens, for example, the U.S. can still tax you on it. Now, there's some limitations to the saving clause, depending sometimes Social Security here, if it's a public or government pension, but baseline perspective is if you're a U.S. citizen, you're probably going to get dinged twice, but you get the foreign tax credit to offset that. As I discussed, the saving clause, I have a whole other presentation dedicated to the saving clause, but saving clause just basically says, despite what it says in the treaty, the country, for the U.S., it's for their citizens, they can still claim that they have to pay tax on their worldwide income. So in like a pension situation, since it's not an exception to the saving clause, basically what that means is if a U.S. citizen is overseas and earning pension derived from that country, the U.S. can still swoop in and require that person to pay tax on the income. Business profits and permanent establishments is kind of beyond the scope of this, but essentially, unless the person is working in the other country with a permanent establishment, that other country is not going to have the opportunity to tax business profits. There's exceptions, exclusions, and limitations. None of this really impacts reporting. If you're a U.S. citizen, let's say, or either way for this one, right? But if you've got foreign accounts assets, investments. All of that's reportable in all those different forms. The FBAR, FATCA Form 8938, PFICs, things of that nature. There's a bit of confusion I find sometimes. There's a FATCA agreement, and FATCA agreement may say something like Provident Fund doesn't have to report for FATCA. And that's true, let's say, but that doesn't mean the individual with the Provident Fund doesn't have to report. It just means the organization doesn't have to do the same reporting as a financial institution like ICICI, SBI, Access, any of the banks. If you think you might have made some mistakes in prior years and you want to get into compliance, there's various programs available. Don't read all the BS fear-mongering you're going to find online. It's a bunch of garbage. We have lots of free information available on our main website, goldinglawyers.com. We got a bunch of sub-websites identifying specific areas and nuances like FBAR, Form 8938, Form 3520, etc., etc. You can always reach out and schedule a reduced fee initial consultation if you want. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.